Welcome back to Influvestor. Over the past 40 days, we've tracked 104 videos from 9 of the top financial creators on YouTube, uncovering a massive 45 buy recommendations. We crunched the data to find the ultimate consensus, and today we are breaking down the 3 most recommended stocks right now with actual creator insights. Meta with 7 buy recommendations, Amazon with 5 buy recommendations, and Microsoft with 5 buy recommendations. Chapter Buy. Meta Deep Dive. Let's start with the most recommended stock in our analysis. Meta, ticker symbol META. Currently trading at $675.03, the stock has surged 13.5% over the last 30 days. What's driving this momentum? Well, Joseph Carlson from After Hours, who's delivered an impressive 18.8% annual return, just dropped a bombshell about Meta's advertising dominance.
Of 20% revenue. Just incredible. It might fluctuate between 20 to 25%. Meta is growing so fast in their core business, their advertising, that they're now going to dethrone Google. Google's been the king of ads for as long as I can remember. They've really just held that position since they're a public company, and Meta's finally caught up. The advertising research firm eMarketer projects that Meta will surpass Google in net ad revenue this year, reaching $243.46 billion, edging past Google's $239.54 billion. Meta's ad business is seeing a lift.
Think about that for a second. Meta overtaking Google in ad revenue for the first time ever. We're talking about $243 billion versus Google's $239 billion. This isn't just a milestone, it's a seismic shift in the digital advertising landscape. But the story gets even better when you look at the fundamentals. Ailes' World of Stocks, with a track record of 19.3% annual returns, breaks down why Meta's numbers are absolutely staggering.
Plus, if there's anyone that can afford to spend these monumental amounts of money, well, it would definitely be a company like Meta, who last year, for example, in just 1 year's time, they did over $200 billion in sales, which was up 22% year over year, with over $100 billion of that going to EBITDA profit, which is up from $38 billion just a few years ago. That's gigantic growth for their already massive size at around 170%. And again, it's the reason why their PEG ratio is so low, right? Because the company continues to grow at incredible rates. A PEG ratio actually factors in all of that growth. Well, the only way that you can maintain that in
$200 billion in revenue, $100 billion in EBITDA, and 170% growth. These aren't just good numbers, they're exceptional. But here's where it gets really interesting. Some analysts have been questioning Meta's competitive moat, especially with new AI players entering the market. Joseph Carlson has a powerful rebuttal to these concerns.
Rather than a signal that the company is strongly placed for what's to come next. Okay, so there we have the argument that Google's way better positioned than Meta. Now, I'm going to have to take the other side of this. I do disagree with the author here. I don't believe that Meta surpassing Google in ad revenue is signs of the last hoorah of a dying company. I don't believe that at all. When we look at Meta, this shows that this company is more ruthlessly efficient in figuring out user behavior than any company on planet Earth. It knows what you want out of life. It knows what type of content you like watching, what type of content prevents you from watching something. It knows what type of people you surround yourself with. It knows where you live. It knows everything about you. And no, it doesn't have to listen to your conversations to accomplish that. It doesn't have to have the mic on in the background or any type of conspiracy theory. What Meta does instead is have such an advanced understanding with AI of your user behavior. All the nuances, all the things that you click on, the seconds you spend watching something, all the interest that you have with selling things on the marketplace, chatting people in different social circles, all of that is placed in the Meta's intelligence to form a profile where they understand every single person on Earth. Now, every company does this to some degree. They try to understand their customers to better serve them and create products and market to them as well. But nobody does this better than Meta. No other company has this much data on this many users. And while Meta lacks the Gmail and they lack a YouTube and all these different properties,
that's the key insight right there. Meta's unmatched understanding of user behavior across billions of users. This isn't something you can replicate overnight, even with the most advanced AI. Speaking of which, Deutsche Bank just released an extensive bullish analysis that Joseph Carlson covers, highlighting Meta's Muse Spark AI advantages and multiple growth catalysts.
More efficiency, higher margins, more cash flow. They continue on and shift the argument for Meta's rise now to Muse Spark, which is Meta's new AI model. We can see it again right here, currently number 5 in the App Store. That's right there next to Gemini and ChatGPT. Meta also recently released Muse Spark, the first foundational model coming from the revamped Meta Superintelligence Lab, which we think is geared towards supporting Meta's core business and Meta AI Assistant. It has been engineered from the ground up as a natively multi-model reasoning engine, designed to seamlessly integrate visual data with text and tools. This differs from some existing models that have had multi-model capabilities added on. So basically, Meta's model was built from the ground up multi-model. Some other models are built for different reasons, and then they kind of patch together different aspects of it to make it multi-model after the fact. And they believe that Meta's architecture is actually better for their needs. A key innovation is the contemplating mode, which utilizes multi-agent systems to tackle complex problems in parallel, aiming for deeper analysis without significant latency. And even as importantly, per Meta, Muse Spark has been architected for efficiency. It uses an order of magnitude less compute resources, which is critical in an environment with severe chip shortages for deployment in smaller form factors. They talk about the contemplative mode. This is actually something that I saw new with Meta. I've never really seen this before. Basically, you query something that's like more deep, right? A thoughtful thing. And usually what happens, like if it's in Gemini, it'll just have the one thing spin through and kind of explain what it's doing. With Meta, it does that, but it's like 6 different models all running, or the model running 6 different times in parallel. All of them are factoring through this reasoning, and then it synthesizes the outcome from all 6 of these. Based on the reports from independent benchmarks, we believe this new model may not have entirely leapfrogged the top tier, but it still is highly competitive, particularly in visual analysis, reasoning, and healthcare applications. Now, they continue on talking about how not only this justifies part of the Reality Lab spend, but also how careful Meta is in having this tailor-made for all their future applications. They say Muse Spark is a potential software unlock that Reality Labs needed to justify its large cash burn. Because the model is highly efficient, natively multimodal, it appears that it is tailor-made for edge devices like Ray-Ban, Meta smart glasses, and future AR headsets. When an AI processes visual and auditory inputs simultaneously and natively, it drastically reduces latency. This means that the glasses can see what the user sees in real time, overlaying visual objects in real environment, translating live text, or offering contextual advice without the lag that ruins the AR illusion. Basically, if Meta didn't build this themselves, and they relied on some other third-party model that's a taped-together multimodal, then they wouldn't be able to use this in their own products without latency. So having their own model, purpose-built, makes it so that the whole ecosystem works. Now, you have this also, I think, contrasting with Apple. Apple doesn't have their own tailor-made model. They're working on different ways to try to bring down latency, but Apple will be by far the biggest competitor with Meta with the Ray-Ban smart glasses. We know that Apple's working on smart glasses. Apple has the ecosystem. They have the App Store. They have the iPhone in everybody's pocket. They can do a lot of things that Meta can't do. But with Meta's massive investment in owning their whole stack of AI, this is actually giving them somewhat of an advantage in some areas, even to compete with Apple in hardware. And this is why a lot of investors are saying it's a good thing because Apple's saving cash on not investing in their own AI models, where I believe it's actually a risk for the company. Apple could be giving up significant technological advantages by being unwilling to invest in AI at the same level that Meta is. But we'll see how that turns out. Right now, I think that Meta is making good ground. In healthcare and wellness, Meta collaborated with over 1,000 physicians to curate training data, enabling Muse Spark to provide more accurate and interactive health insights and generate nutritional content, explain muscle groups activated during exercises, and generate interactive health displays. This positions Muse Spark as a daily wellness companion, moving beyond generic chatbot responses. While it is not a substitute for professional medical advice, its ability to interpret images and charts could provide more tailored guidance than text-only models. By positioning Muse Spark as a daily wellness companion, Likely by integrating wearables, Meta could create a sticky, high-frequency use case. This strategy could yield ecosystem retention while collecting high-intent data, diet, fitness, and health goals that would ultimately prove to be valuable targeting for advertisers. This puts them in competition with both Amazon, which I believe is trying to push into healthcare with more of a pharmaceutical approach, but it also pushes them against Apple. Apple is trying to become a healthcare company with the watch, with the glasses, but they do not have the model that Meta has. This is why I believe that this investment, the $100 billion plus into CapEx, could be well worth it for Meta. It opens up entirely new business lines, new technology that you can't do without it. In terms of shopping, Muse Spark is set to power a new shopping mode that leverages Meta's vast ecosystem of creator content on Instagram and Threads. The AI can provide personalized product recommendations based on a user's interest and the content they engage with, effectively turning social media posts into shoppable interactions. By natively integrating AI into discovery phase, we think Meta is compressing the funnel between inspiration, seeing a creator's outfit, and the ultimate transaction, buying the item. If this scales, it should materially boost conversion rates, allowing Meta to charge a premium for AI-assisted ad placement and keeping users inside the Meta ecosystem rather than defecting to Google Search or Amazon. Keep in mind, Meta has 3.58 billion daily active users. They have the entire customer base of half the world using their product already. So they don't need more new customers, they just need to be able to vertically integrate it, make the shopping experience more seamless, remove friction. And they're highlighting a specific way that Muse Spark, this new model, can do that. With the focus on supporting the internal operations, it is not surprising given Meta has said it believes that returns from the upcoming models will primarily come from the consumer experiences they build, such as making content more engaging across their family of apps. So in terms of monetization and how this factors in with the business, it is likely that Meta AI will have a pro mode, that the more wealthy consumers of Meta can pay for to have an advanced AI as their daily driver. But I don't believe that that's even close to the main way they're monetizing this. They're going to monetize it by integrating it into all of their ecosystem, making it so that all of their distribution, all of their touch points work better. They already have the biggest audience in the world. Now they just need to leverage it. There's also a number of other advantages that they outline here. Commoditizing the base, monetizing the frontier. By open sourcing Llama, Meta commoditized the foundational layer of AI, creating a wide ecosystem of developers and applications built on its technology. With Muse Spark, Meta can now offer premium, cutting-edge features and capabilities as a paid service, potentially through APIs or subscriptions, creating new revenue streams beyond advertising. In the competitive advantage, keeping the architecture of its most advanced model closed prevents competitors from easily replicating its innovations, particularly the multi-agent contemplating mode. This is crucial in the highly competitive frontier model landscape in our view. Enterprise and high-value applications. A closed model allows Meta to offer more controlled, reliable, and secure solutions for enterprise clients, particularly in regulated industries like healthcare. This approach is similar to that of competitors like OpenAI or Anthropic. In our view, as we've highlighted before, the big picture here is that 1. Meta made the necessary investments to support continued user engagement growth at scale. 2. It has created the most durable advertising platform across the group. And 3. Is leaning in to foundational AI model training work, which is unlocking new vertically integrated opportunities across large total addressable markets, including business messaging, Meta AI, potentially searchable advertising, scaled wearables, with 2026 even shaping up to be a year of ramped product releases, including an array of new AI model launches. As such, notwithstanding the broader market pullback, we think the dip creates a buying opportunity. This stock is a high-quality compounding machine. It has an ever-growing moat. It is on the forefront of a lot of technologies, and it's being driven by Mark Zuckerberg that is aware of the concerns but willing to make the hard investments that have the biggest payoff. The market still looks at this as a company that will have low returns when that's already proven wrong. So while Meta trades at the low 20s PE ratio, it should be trading up there at the high 20s. We should see continued multiple expansion from this stock going forward, not to mention the rapid earnings growth. They believe the stock today should trade at a 27 PE at a price of $920. Meta currently trades at $670. So there is a significant gap of where this one could continue to go. I think it will. Now moving on, we get to an interview with Jensen getting a little upset.
Now, I know what some of you are thinking. But what about Meta's reputation issues? The privacy concerns? The regulatory headwinds? Joseph Carlson addresses this head-on, making a crucial distinction that every investor needs to understand.
Owning companies that have good reputations amongst their consumers and amongst the other parties involved. Also, Joseph, I'm buying $150,000 of Meta. That got a lot of likes as well. And I see it. This is a great criticism, great comment. It's highlighting, a pretty good contrast where obviously Meta doesn't have a great relationship with every party involved. And I see that. Now, again, great comment, but I think there is some big distinctions here. The reputation that Meta has is largely a consumer populist, a reputation because they have 3+ billion users. When it really comes down to it, people love Meta products. They have billions of users on them every single day. Now, a percentage of those users are always going to vocally complain. A percentage of those users are always going to sue. It's just the law of average. It's the statistics. When you have billions of users, you're going to have lawsuits, you're going to have complaints, and you're going to have politicians that take advantage of that. But I see the complaints with Meta and the distrust from some consumers as a much more social thing than I see with FICO. I see FICO having a structural problem with its relationships with other parties. The government and other businesses hate FICO far more than they hate Meta. Far more. And you can look at this. Companies have gone from simply disliking FICO, companies that work with them like mortgage lenders, to being openly hostile with FICO. They hate them. They have had their prices and their input costs go up over 10x in a couple years. Banks want nothing to do with them. Even though they have to use them, it's by twisting their arm. It's because they're the only viable option. The government is actively trying to create a competitor. They're plugging in VantageScore. They're doing everything they can. So the hostility between FICO and the government and other companies, I believe, is much more structural, much more important. I'd say it's much more meaningful than the overall bad reputation that social media has with Meta. So I see the comparison, but I think there is some defining differences. Now that's going to be it for this episode. Hope you enjoyed. See you in the next one.
He's absolutely right. There's a massive difference between social media backlash and actual structural business problems. The numbers don't lie, and Meta's business fundamentals remain incredibly strong despite the noise. Newsletter CTA. Before we move to the next stock, a quick heads up. If you want these alerts in real time, join our free newsletter in the pinned comment. You'll get instant notifications whenever these top-tier creators recommend a stock, plus monthly deep dive reports just like this one to maximize your investment returns. Don't wait for the algorithm. Amazon Deep Dive. Now let's dive into Amazon, ticker AMZN, currently trading at $263.99 with an impressive 24.7% gain over the last 30 days. The AWS story here is absolutely massive. Joseph Carlson reveals something that should make every investor sit up and pay attention.
However, customers want better price performance. We've seen this movie before. In the CPU space, virtually all of the workloads ran on Intel chips until we invented Graviton in 2018. Graviton, which has up to 40% better price performance than other x86 processors, is now used expansively by 98% of the top 1,000 EC2 customers. The same story arc is unfolding in AI. Our second version of our custom AI silicon, Trainium 2, has about 30% better price performance than comparable GPUs. Comparable GPUs is NVIDIA. So they're saying they already have better price performance. And it's largely sold out. Trainium 3, which just started shipping at the start of 2026 and is 30 to 40% more price performance performant than Trainium 2, is nearly fully subscribed. So even the ones just starting to ship, they're sold out. People want these. NVIDIA has net profit margins around 65%. They sell their chips at a massive markup, and Amazon knows that. Amazon already looks at industries across the board that have huge profit margins, and they say, hey, can we make this a better value for consumers? Can we go after that company's margins? This is exactly what they're doing with their custom chips. They're saying that we want to take these profit margins of NVIDIA that we're paying for them down by 80%. We only want to have 20, 30% profit margins on these chips. We'll sell them to our customers and give them a better value so that they'll come to us. We'll get more compute. we'll get more business. And this is happening, and it's happened before. He's already said that we've seen this movie before, the same thing with Intel. This is the problem with being the supplier of the chips, is that your customers can essentially develop the same thing. He continues on, a significant chunk of Trainium 4, which is still about 18 months from broad availability, has already been reserved. So we're looking out, 18 months in the future, and they already have this stuff booked. It's sold before it's even close to getting to the market. Now, not only will the use of Trainium chips, their own in-house chip development, save customers a ton of money, it's going to save Amazon a ton of money. Again, when you don't have to go out and license other chips and have them develop.
Over $100 billion in customer commitments, including OpenAI, with capacity being fully monetized as fast as it's installed. That's not just growth. That's guaranteed, contracted growth. But here's something most investors are completely missing about Amazon. Joseph Carlson drops this gem about their chip business.
It saves money for both the customers and you as a business. They say having our hotly demanded AI chips opens up many possibilities, but perhaps none larger than the ability to lower costs for consumers and secure better economics for AWS. At scale, Trainium will save us tens of billions of CapEx dollars per year and provide several hundred basis points of operating margin advantage versus relying on other chips for inference. So they're diversifying away from NVIDIA being the all-powerful constraint and bottleneck to computing. NVIDIA had a good run. They were the first ones to really have the chips in place. Everybody went to them, which has boosted NVIDIA's earnings like crazy. But now that companies like Amazon, Google, and Microsoft can develop their own chips, they're not going to be quite as reliant. And this is part of the reason why I believe that companies like Amazon, Google, and Microsoft have much more resilient and reliable and durable business models than NVIDIA. NVIDIA is an input cost to their customers, which are actively working on ways to try to mitigate that cost. One of the most incredible stats here that he shares is just how big their chips business actually is. And as a standalone business, it's massive. Our annual revenue run rate for our chips business, inclusive of Graviton, Trainium, and Nitro, our EC2 NIC, is now over $20 billion. To put that in context, let's just compare it against the stock. Let's bring up one here. We'll go to Qualtrim and we'll plug in AMD. Let's take a look at AMD. We bring that up. What is AMD at with their business? They're at $34 billion. So Amazon is where AMD was in 2023 with just their chip business. Just one business of Amazon that really nobody's pricing into the stock today. And fun fact, it's also growing triple-digit percentages year over year. Triple-digit percentages. To dimensionalize this versus other chip companies, that run rate is somewhat understated by our currently only monetizing our chips through EC.
Think about that. Amazon's chip business alone would be worth $50 billion as a standalone company, comparable to AMD's entire market cap, but growing at triple-digit percentages. This is a hidden asset that's not being properly valued by the market. Financial Education, who's achieved a remarkable 26.9% annual return, provides a comprehensive analysis covering all three core businesses and why the valuation is at historic lows.
You can send it over via email, via text, however you want to receive it. I think you guys will get a lot of value out of that one, okay? Alrighty, number 2 of these 5 stocks is this one. It's called Amazing Zon. I call it Amazing Zon. It is Amazon, okay? Look at, this is pretty shocking, I think, to a lot of people. If I just told you what has won over the past 5 years, Amazon or the S&P 500, I think almost anybody would say Amazon. Amazon has to outperform the S&P 500 on a 5-year basis. That's crazy if it doesn't, right? It's Amazon we're talking about here. Guess what? Amazon's gotten crushed. We're talking less than half of the performance of the S&P 500 over the past 5 years. How do I say it simply? Amazon stock has sucked the past 5 years. It has gone through, you look at the business over the past 5 years, it's in a better place than it's ever been, but the stock price has sucked, right? And so I do not believe that's going to be what happens over the next 5 years. I can tell you that much. Year to date, also Amazon's underperforming. S&P 500 down 4% year to date. Amazon down over 7% year to date, okay? The thing you got to understand about Amazon is they own a lot of different businesses. And I mean a lot of different businesses. But they have 3 core big businesses, okay? It's a 3-headed dragon, I call it. One is the e-commerce business. We all know I would say far majority of people watching this video, you probably order stuff on Amazon, maybe every single week. Some of you guys might be every single month, right? But almost everybody orders some stuff on Amazon. That's their one big dog business. AWS is now their most important business. It's even more important to the company than e-com, even though, you see the Amazon trucks driving all over the place. You order stuff on Amazon, you would think like e-commerce has to be the biggest business. No, AWS matters much more significantly the profits of the company and ultimately the company's valuation than actually the e-commerce business does. So AWS is the most important to Amazon, and they have their ads business. And the ads business can make money from the e-commerce side. Also, the ads business can, now they buy NFL rights to some games and other sporting events, right, and other shows and things like that. So the ads business has grown immensely, and that's a profitable segment there, the ads business, right? And all three of those are great growth businesses for years and decades to go in the future. It's not like, oh, those are just hot businesses right now. No, they're hot businesses for the next 10, 20 years, right? So that's the amazing thing about those. Now, we're looking at 1000xstocks.com right now. Look at the revenue on the trailing 12-month basis. Is that not perfection? That's exactly what you want to see from a company. Amazon is showing you exactly what you want to see. Consistent, great, strong revenue growth with many quarters coming in 10% plus revenue growth. Look at the earnings per share. This is where we're at right now on a trailing 12-month basis. This is where we're expected to go for earnings per share of this company. Beautiful, right? Now, why is the stock done so bad despite revenue, earnings per share, these sorts of metrics doing amazing? Look at operating cash flow. It's higher than it's ever been. And you say, how is this stock so bad versus S&P 500? Well, the stock used to be insanely expensive. On a trailing 12-month PE basis, on a forward PE basis, it used to be a very expensive stock. Those days are over. Now Amazon is a very, I would say, cheap stock, especially given the growth rates that Amazon has. So you're getting the stock for around the cheapest you can pretty much ever get it, right? This is looking at 1000xstocks.com historical PE ratios. Look at, you're way down here. So the stock is actually cheap now, especially given the growth rates compared to back here, when you're trading at 190 PE ratio, you're an expensive stock, right? And let this be a lesson to everybody that feels comfortable buying stocks when they have PE ratios of 100, 200, 300. Just understand, you could go through 5 to 10 years of a stock that doesn't even perform as well as S&P 500, doesn't even perform as well as a NASDAQ. Let this be, just because you buy an amazing business does not mean you're guaranteed to make money over 5, 10 years. You have to buy an amazing business with great growth at the right valuation. I think Amazon's going to crush the S&P 500 returns over the next 5 years. But that's because the growth with the now cheap valuation. 5 years ago, sure, they had plenty of growth ahead, but the valuation was not attractive, not an attractive valuation back then, right? Once again, operating cash flow is higher than they've ever been. Look at AWS. So AWS is in a very exciting moment in time. They went from 17% growth for the AWS side of the business to 17.5% to 20% to 24%. This is what you got to see. They're spending like crazy at Amazon, but you want to see them come through with the big growth rates of AWS. Now keep in mind, this is very important. Okay, listen. Amazon's spending a fortune right now. I mean, absolutely ridiculous numbers as far as CapEx. I mean, we could be talking about as much as $200 billion this year. The good news for Amazon is this has always been an insanely heavy CapEx business. From the e-commerce side of the business and all those massive warehouses you see all over the United States of America and all over the world, all those airplanes they've bought over the years, all of those Amazon vans that drive all over the place, right? All the AWS data centers. This has always been a company that is extremely CapEx heavy. Now it's even more CapEx heavy than we've ever seen it, but it's always been there. So it's a little different than like Meta, than Google, than Microsoft. Those sorts of companies have always been a little more asset light and are now becoming asset heavy. So they're having to go through really tough valuation times right now, right? AWS has always been a heavy CapEx company, and they've always faced questions for decades about, why are you guys spending so much on this? Are we sure we're going to get the payoff here? These sorts of things, okay? So that's something very important to understand and remember in regards to the AWS and to the Amazon story in general, right? Now, Amazon is the third biggest stock in the public count, up $107,000 on it, up about 49% on it so far. I want to build this stock even into a bigger position. It's still a great deal. If you're a long-term investor, where the stock is over the next 3 months is anybody's best guess. Could be 180, it could be 280. Like, who knows, okay? But over the next 5 years, this is a much higher stock than it is today, right? And they just continue to grow, and they've got the beautiful thing is they got several segments that are just going to grow for, 10, 20 years in the future. It's like you don't even have to worry about them. The e-commerce business is going to keep growing. You don't even have to, you could just sleep and just own it. Same thing with AWS, same thing with the ads business. It's beautiful, right? The only positions I have in the public account that are bigger are AMD, Meta, right? In order to be that big of a position in the public account, I have to believe in you a lot.
The valuation opportunity at historic lows combined with AWS growth acceleration is a powerful combination. But here's what's really exciting. The Wall Street narrative is shifting. Stealth wealth investing, with an incredible 35.7% annual return track record, explains how the sentiment is changing.
The future path from here, and again, a lot of this hinges on AWS.
Wow, amazing how the narrative on Amazon magically switches. They were, as of last year, basically a year ago, oh, they're way behind. Oh, everybody's eating their lunch. Oh, Anthropic's going to ruin them. And all these other crazy narratives, just like with Google. And we sat right there and said, hey, just buy the freaking stock. I just bought stock a few weeks ago for $199, $198, whatever the heck the case was, under $200 is the point. Just a few weeks ago, and I've been basically had it on my DCA for the past year. So I've been DCAing the stock for the past year. Now all of a sudden, Wall Street's getting on board. Oh, magically, Amazon's doing something different. Oh, magically, I don't know, what was it? 4 months ago? I guess 4 months ago. Yeah, Amazon spending $200 billion was a bad thing. Now all of a sudden it's a good thing. It's just stupidity. This is just Wall Street narratives driving trades. This is why you simply just use valuation, buy it whenever it's undervalued, and ignore all that other noise. Amazon is an incredible company, just like Google is an incredible company, but yet people wouldn't touch Google with a 10-foot pole a year ago, 2 years ago. Now all of a sudden, magically, it's the darling of Wall Street, and now the narrative is starting to change around to Amazon here. Doesn't mean it's going to the moon or anything else of that nature. I have no idea if it'll make a move like Google did or not. It also wasn't beaten down for as long as Google was. But nonetheless, you're getting Amazon at an incredibly cheap valuation, even at today's prices. And that right there just shows you how silly and how dumb all these Wall Street narratives are. The company has...
When Wall Street starts calling a stock incredibly cheap, you know something's shifting. But the real confidence booster? Amazon's proven track record. Stealth wealth investing puts this in perspective.
And efficiently to, bring future profits to basically make that investment now worth it into the future. Amazon's one that has a track record now for, really 30 years of simply executing on an extremely high level over and over and over again through multiple technology changes, through multiple, massive shifts in this and that and the other. And, anything you can think of, they pretty much weathered it over the course of that 30-year period. So I got no issues at all adding Amazon at these levels. Next up is Meta. Meta fits kind of in that cat.
30 years of consistent execution through multiple technology shifts, from books to cloud computing to AI. That's the kind of track record that builds investor confidence. Microsoft Deep Dive. Finally, let's examine Microsoft, ticker MSFT, trading at $424.62 with a solid 14.4% gain over the past month. The valuation story here is compelling. Dividend data, with a 19.7% annual return track record, highlights something remarkable.
Great long-term purchase, and it's actually more attractive now. In fact, as we sit today, Microsoft stock is trading at a forward P ratio of 20. This is the lowest valuation that Microsoft has traded at since 2016, lower than the April 2025.
A forward PE of 20, the lowest valuation since 2016. For a company of Microsoft's caliber, that's extraordinary, but it gets better. Dividend data also reveals this crucial metric about their future growth.
And just one quick data point, I'm not going to dive into this and do a whole analysis, but the total remaining performance obligations, this is booked revenue that Microsoft has in the future. This has been climbing significantly since really the whole AI data center build out has started. It's gone from $200 billion, it went up to $400 billion. And in the latest quarter, it jumped up to $631 billion. Microsoft Azure, their cloud business, is growing just under 40% annual.
Performance obligations jumping to $631 billion, with Azure growing 38% annually. That's visibility into future revenue that most companies can only dream of. Let's Talk Money's Joseph Hogue, a CFA with a 22.8% annual return, provides an incredibly detailed analysis covering multiple growth drivers.
relative to its own history, but also cheap compared to the rest of these stocks. Coming down here, looking at Microsoft, ticker MSFT, Mr. Softy, might not have the fastest revenue growth at only 16.4% revenue growth expected this year. Still a little pricey on that adjusted valuation, but it is giving us a great discount, 31% discount to its average valuation. Microsoft's Azure Cloud Services is holding its own against Amazon and Google, and we're hearing about solid adoption of its Copilot agentic AI. So a lot of strength there. It's also a good value just on that existing business. And what I think here has a lottery ticket upside on its ownership of OpenAI, okay, ChatGPT parent. We saw over the last couple of months in that restructuring of OpenAI, Microsoft got almost a third, 27% ownership of the ChatGPT maker, a stake worth $130 billion right now. Now at a market cap of about $2.6 trillion, and with the OpenAI planning to IPO later on this year, it could be a windfall for Microsoft. Now, I know everybody wants to pit OpenAI, Anthropic, and Gemini models against each other, but what we're actually seeing is that customers, enterprise and consumer customers, are using more than one model. So there is still room for multiple winners here. Okay, Claude, Anthropic is used by more enterprises, but GPT is still by far the runaway leader in consumer AI usage and is getting a strong growth from enterprise. So I think OpenAI is going to do very well in that IPO. A lot of investors are going to want a piece of that. That is going to be a windfall for shares of Microsoft. Down here, Cloudflare, ticker NET, is another stock that just...
The OpenAI stake alone being worth $130 billion with an IPO catalyst on the horizon, that's a massive hidden asset. But here's what really matters for long-term investors. Dividend data explains why all this AI infrastructure spending isn't just burning cash.
Where it's like the better example, and what Bill Ackman was talking about, is the AI data centers right now, how they're outlaying tons of CapEx. But this is, in my opinion, 100% it's in the growth CapEx category, because they already have the revenues and profits they're generating from the data centers they already have built for that AI demand. They have contracts with the future AI demand, and they're like, yeah, we have this visible revenue. We just need to build a supply, and it's all going to come. So that's like the two different ways.
This is crucial. AI data center CapEx is growth CapEx with visible revenue and contracted future demand. It's not speculative spending. It's investment with clear returns. And Eyal's world of stocks sums it up perfectly.
Buying the most heavily. Now, I will say just right off the bat that Microsoft will be, of course, my number one target, just because of how much larger and stronger their business is above everyone else on this list here. I really have the most conviction for this one. The fact that we're negative on it means I want to be buying a lot more. But like I said before, I do also love my REITs right now. So,
when a creator with a 19.3% annual return identifies Microsoft as their number one target for future purchases, that's a strong endorsement of the business strength. Outrow. So there you have it. Meta, Amazon, and Microsoft represent the highest conviction picks from top financial YouTubers right now. Meta's advertising dominance and AI advantages, Amazon's undervalued AWS and chip businesses, and Microsoft's attractive valuation with massive growth visibility. These aren't just popular stocks. They're backed by creators with proven track records ranging from 18.8% to 35.7% annual returns. What do you think? Are you buying any of these three giants? Which one excites you the most? Drop your thoughts in the comments below, and don't forget to join our free newsletter for real-time alerts when these top creators make their next recommendations. This is InfluVestor, and I'll see you in the next one.